Leading a financial service firm requires a distinct approach to strategy and leadership. That's why Harvard Business School Executive Education offers a 5-day in-person program focused on leading professional service firms. In this program, participants like you will explore topics such as corporate culture, retaining talent, and communicating a strategy and vision. By the end of the program, participants will gain frameworks to lead change while preserving client satisfaction. Explore the program at hbs.me/client. That's hbs.me/client. Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Gary Farber. Today we're welcoming to the podcast David Miller, co-founder, chief investment officer, and senior portfolio manager at Catalyst Capital Advisors. Catalyst is an alternative investment firm with approximately $13 billion in assets under management, including approximately 30 mutual fund and ETF offerings, including alternative, income, and equity strategies. David oversees many of these strategies, including the Insider Buying Fund, Insider Income Fund, Gold Enhanced Yield ETF, and Tactical Allocation Fund. David, welcome to the podcast.
Thanks for having me. Good to be here.
David, can you share with us the history of founding Catalyst? How did this firm grow and get to its current AUM level?
Sure. Well, I was looking to launch a mutual fund back in the winter of 2005. Had been researching Joel Greenblatt's model, actually, from his little book that beats the market back then. It was a New York Times bestseller. And pretty simple philosophy. Companies that had great free cash flow yield combined with a superior return on capital had a tendency to significantly beat the market by a pretty wide margin. And Greenblatt at that time had been running a hedge fund and had about a 40% annualized return up until that point in time. There were a lot of people who had read that book that were interested in the philosophy, but there wasn't any fund at the time that was actually offering something that could deliver on the concept in that book. So I was reaching out to some fund companies to see if they'd be interested in partnering with me to launch something. So I actually reached out to Jerry Szilagyi, who's now my partner in Catalyst Funds and CEO of Catalyst, and was at the time head of business development at a firm called Integrity Mutual Funds. And he was running their Long Island office for business development. Now, while he really liked my idea and the marketing plan around it, their board was not so enthused with the idea, especially with the idea that I was a 25-year-old at the time who had no experience running a mutual fund. Understandably, they had some hesitations, which turned out great for us because they said no. And them saying no resulted in them agreeing to Jerry to say, well, we're not going to do it, but you can go out and do that on your own on the side. So we decided to launch Catalyst Funds back in 2006 and launched our first fund. And it's been quite a ride since then. We're heading on to our 20th anniversary now and grown it from about $500,000 when we launched back in July of 2006 to, collectively between our Catalyst Funds, Rational Funds, and strategy shares ETFs groups to, a little under $14.5 billion now. So it's been a great ride.
And given that you took that entrepreneurial path, are there some key takeaways you have for others as far as keys for success in founding your own company?
I'd say, in the real estate business, they say location, location, location. With business, I'd say it's persistence, persistence, persistence. Everything is really hard in the beginning. When you're first launching your first fund, you have virtually no AUM, virtually no track record. If it's on a mutual fund or ETF, almost no platform availability. So a lot of it is just not giving up and, pushing that rock up at the hill and making sure that you have a good enough idea that the market really needs what you're creating. Because it's not like technology where you have this thing with a product market fit where the market certainly suddenly realizes, hey, you've got a better widget and they can plug that in. They need to see all these things that indicate to them that it's something worthwhile to invest in. They need to see some pedigree. They need to see some reputation. They need to see some track record. They need to see some AUM. And you have none of those things in the beginning. So it's making sure that you really believe in what you're doing and that you don't give up until you're successful. And you do all those things that you need to line up the initial capital, make sure you're making smart investments, and most importantly, just persist.
What's your read so far of the earnings that have been coming out?
Sure. Well, I mean, if you look at earnings, certainly tech earnings are still quite strong. Certainly, these memory stocks are on fire. The Nvidias of the world are continuing to grow. Certainly for oil and gas companies, it's been outstanding for them as well with higher energy prices. But those companies that are not participating in that are having a pretty rough time. So it's a very bifurcated market that we're in today. And I think this is definitely one of those environments where that philosophy makes the most sense because year to date, we're up a little bit, but we had a pretty rough bear market earlier in the year. Whereas now it's certainly recovered, but it's been a great period for managed futures because you had a great trend in oil prices over the past year and a huge trend in the price of gold. So it's really been one of those years where making sure you're truly diversified makes even more sense than it normally does.
And digging further into the macro, obviously a higher level of geopolitical risk. How does that get incorporated into your strategies or your just overall investment mosaic? How do you think about that?
Sure. Well, when you think about those geopolitical risks, certainly the biggest one isn't even a risk. It's already happened, the closing of the Strait of Hormuz. Although the calculus around that geopolitical risk has shifted quite a bit. I think people used to always think oil shocks are bad for the economy. They're bad for corporate earnings. They're probably bad for unemployment numbers. But all those things shift when the dynamics of your economy shift. If you think about the Gulf War, in the early 90s and the shocks around that, or the Iran-Iraq War in the 80s, terrible for the U.S. We're big consumers of oil, and it was pretty much all coming out of the Middle East. Now we're a net exporter. The coin has really flipped to the other side. If you're a net exporter, when oil prices go up, that's actually tremendously positive for you. And it's not just kind of positive, because if you're a user of oil, yeah, it's an input into your business costs and it goes up, but it's generally something you can stomach and it affects your margins. But if you're an oil company and the price of oil doubles, you have incredible operating leverage to that increase in the price of oil. It's going to, far more than double your margins when something like that happens. So now that we're a net exporter, interestingly, I think it's actually very bad what's been happening, for Asia. It's terrible for Europe, but it's actually been, a net positive for us in the U.S. because we can certainly ship as much oil or more oil than we were previously. And you have a lot of this supply being taken out from Iraq and Kuwait, where they can't really get their oil out through the Strait of Hormuz.
But is there a level of the price of oil where you become concerned about sort of material impact or how the consumer is going to fare that might impact your view of the market at all?
Yes and no. So certainly there's some price that's just too high that it impacts the consumer and businesses more than this huge boon to the oil and gas companies, where that incremental dollar price results in reduced consumption and just kind of slows the economy overall. But when you look at it, people have this saying that, okay, 20% of the world's oil comes through the Strait of Hormuz. And yes, was that historically true prior to the closing of the Strait of Hormuz? Yes. But are there workarounds? Yes. You don't have to get the oil out through the Strait of Hormuz. If you're Saudi Arabia and you have a pipeline that goes out to the Red Sea and you can get 7 million barrels out per day, if you're UAE and you have your own pipeline as well, you can get it out to the other side of your country where the Strait of Hormuz is not an issue as well. Now, is that a problem for the incremental production from Iran during a blockade? That's going to China otherwise? Absolutely. Is that a problem for Iraq and Kuwait where they can't really get their oil out? Certainly. But I think the world can handle taking 10% of the supply off the table in some of these countries like, UAE, which recently got themselves off of OPEC, or other countries, specifically the U.S., where we can do marginal incremental production through the Permian Basin and out through the Gulf of Mexico. It's not like we can't produce a bit more to offset some of those decreases. So I think we're probably in this situation where we've got about $100 a barrel of oil, or even a little bit over that, if the strait stays closed for a long time. But that's not something that's unmanageable.
Besides geopolitical interest rates, the Fed, how do you think about those? What's the path forward, you think, for the Fed?
Well, I think the Fed has to basically take a wait and see mode until this conflict with Iran is fully finished. Now we've shifted from the hot war, the kinetic war, to instead this blockade. But that's going to have to go in one direction or another. It's going to either lead to peace, and there's going to be a deal done, or it's not, and the kinetic war will start going again, or maybe it won't, and the U.S. will eventually just do things on the ground to take the land that's adjacent to the Strait of Hormuz, so that that the IRGC can no longer block it. But I think we're in a wait and see mode. I don't think that there seems to be any meaningful chance that the Fed's going to go ahead with a cut. I also don't think they want to hike and do something kind of erratic. So I think we're just in wait and see mode until things calm down, and rates are probably going to stay about where they are.
David, shifting into investment themes, are there particular themes that you find very compelling right now, either in the near term or longer term, that sort of shape your investment view?
Sure. Well, when you look and see where the tipping points in the market are, or where there's bottlenecks in the market, and where that can really drive incremental earnings for certain companies, or really hurt their earnings, there's a few areas where that's playing out. So you certainly have the one in the AI space, and the original one was, I think, around training, which really fed into the earnings for the chip makers, the NVIDIAs, the AMDs of the world, or those companies facilitating the making chips like an ASML. I think we've really shifted now more into the inference, and the amount of compute that's being used now that the models have been built, and that you have two key bottlenecks. One is on the power side. So these companies that power data centers or build data centers, they're certainly a beneficiary of that. But then you certainly also have it on the memory side, because you can't really make all these AI models work without the ability to retain the data that they've created via those models. And the amount of data that needs to be stored is growing exponentially. And that really feeds into these companies that produce that memory, like in SK Hynix or Micron. And you can see those companies, both revenue and earnings, have been growing exponentially. And historically, those types of companies in the semi space have been more have been more cyclical, or extraordinarily cyclical. But there might be a good argument that these are secular bull markets that are really breaking out in that area, and this demand for more memory is not a fleeting trend, but something that's going to have persistent growth to it, and it's certainly undersupplied at the moment. I think Micron's sold out for the next year and a half at extraordinarily high prices, extraordinarily high margins, and certainly likely the same for SK Hynix or for Samsung in that case. And then you also have it on the oil side, although on the oil side, I think that's more a bet as to how long this geopolitical instability lasts for, whereas I think once the geopolitical instability cools down, you could see oil prices dropping even below where they were prior to the beginning of the conflict.
And now a word from our sponsor. If you lead or advise at a financial services firm, this may be something to keep on your radar or to share with a colleague. Harvard Business School offers leading professional service firms a 5-day in-person program for working executives to explore topics like corporate culture, talent retention, and how to deliver consistent client value. Held on the HBS campus in Boston, this program focuses on leadership and strategy by working through real challenges at professional service organizations. You'll build a global network across industries and engage directly with HBS faculty. To learn more, visit hbs.me/client. That's hbs.me/client.
And moving into portfolio construction from a strategy perspective, what would be, if you had to construct a portfolio today, what would be the mix of strategies that you think would make a good portfolio? Your firm obviously has a variety of strategies there. How would you construct a portfolio?
Sure. So we have this strong belief that you need some strategies that do well during bear markets in particular. And the strategies that we found that have the most consistency towards doing well in bear markets tend to be those that are either trend following in nature or macro oriented. So I think that's a key part to building any portfolio. Now, that doesn't necessarily mean that you're going to have your managed futures allocation or your macro allocation within the same book as what you're doing in equities, but it can certainly make it a good bit more capital efficient and can really improve your risk adjusted returns overall if you do it that way. And then when you're building an equity book, I think you need multiple components to it to maximize your Sharpe ratio. I think you need some companies that are the really long-term, persistent, stalwart type compounders where it's incredibly likely that their business is going to continue growing with high margins, high return on equity, strong moats that make it hard for competition to really eat into that business. So if you think about a company like a MasterCard, if you think about a company like a Visa, if you think about a company like a Costco or a company like a Microsoft, those can all be great examples of those types of long-term persistent compounders. And then you want some other companies that can benefit from the transition in the environment that we're in today. I think some of these companies where they're certainly a lot more volatile, but can have some asymmetric upside, and you do some barbelling. So that'd be the companies like a Micron or like an NVIDIA, although you could probably argue that NVIDIA is a long-term compounder at this point as well. And then you want some companies that are on the side where they can benefit from these types of supply shocks like we have in the Middle East. So it does make sense to have some oil and gas companies in there as well. But I think it's kind of a barbelling approach. You probably want 80% long-term persistent compounders, 10% high growth asymmetric bets, and another 10% of your bets that are more diversifying bets like gold miners or oil and gas companies.
And are there sectors you would underweight that you're sort of less predisposed to?
So a lot of people believe in underweighting. I don't really believe in underweighting. I'm a little bit more binary than that. I think there's plenty of companies you should just never touch. And I'd say basically every company that has no real competitive advantage that is in a cyclical business. So let's compare two types of companies. So you have one group of companies, like let's say the Visa and MasterCards of the world. It's incredibly hard to build a new competitor to a Visa or MasterCard, incredibly high return on equity, fantastic margins. They're a perfect example of an oligopoly. They're going to keep growing naturally from more people shifting from cash to credit. They're going to grow more naturally from inflation. Inflation is great for a Visa or MasterCard because they're taking essentially a slice off of every transaction. They have no credit risk. It's not like a credit card company. It's really more they're owning the rails. And then compare those types of companies to, let's say, an American Airlines or a Delta Airlines or a United Airlines. They're really the opposite. Anybody can fly from point A to point B. You have to fly from point A to point B, whether or not oil prices are $100 a barrel, whether or not you're in a terrible recession, whether or not you're in COVID and there's nobody on the planes. And your margins never get that great, even when the demand for those flights takes off because incremental supply can come online. So I'd say you really want to avoid the restaurant type businesses of the world, the companies that are in simple manufacturing type businesses, the airlines of the world, basically anything where there's pure competition, and focus the majority of your portfolio in those companies that have exceedingly strong moats combined with very high gross and net margins.
And as we sit here today, much of the market still being driven by mega cap tech. And now we may have some artificial intelligence IPOs further weighting the index in that direction. What does that mean for investing, and what does it mean for risk management of a portfolio if you're so weighted towards a sector?
Sure. So I think a lot of people are uncomfortable being heavily weighted towards the sector, and purely from a risk standpoint, that makes sense. But there's this other element of investing that's very important to recognize, which is that investing is not a business where you do better than the market or even equivalent to the market if you equal weight your bets regardless of your conviction, because it's really a power law business. There's some of these companies in every cycle that make up the vast majority of the S&P 500's returns, and the vast majority of those companies, 90% plus in aggregate that aren't in that group, that end up systemically underperforming the market. So you need to own these companies that have the biggest returns Otherwise, it's going to be impossible for you to even get remotely close to the returns of the indices. And I think a lot of people think of the S&P 500 or something like the S&P 500 as being a bit inferior in that it's deliberately average. Although I think there's actually something truly brilliant about the S&P's construction in that if you own the S&P 500, you could not have possibly missed NVIDIA when it was a much smaller company. You could not have possibly missed Microsoft when it was a dramatically smaller company. You could not have possibly missed any of these firms that were the 100x, 1000x returns, and you need to own those 100x or 1000x returns. Otherwise, you've got to beat the total returns of the index without them, which is by any real means pretty close to impossible. So I think the beauty of the S&P 500 is that it is market cap weighted rather than evenly weighted, meaning you are forced to own your winners and let your winners ride, and you're also forced to let your losers get much, much smaller over time. And I think that's actually a really sharp investing philosophy, which is why I think the S&P 500 is so hard to beat, because it's actually such a smart portfolio construction.
And the traditional 60/40 portfolio, your view on that, does that still work in today's environment?
Well, I guess work is a different question than is it what people want. So certainly the equity side has worked exceptionally well, and the 40 side, the bonds, had worked incredibly well while we were in a multi-decade bull market for bonds. But the problem is, if you think about bonds and you think about where they actually sit today, and you look at inflation rates and tax rates, if you own a bond, first off, you got to take whatever your return on that bond is and subtract the inflation rate to get your real return. But that's not the only thing you need to subtract. You also have to subtract your tax rate. And after you subtract both your tax rate and the inflation rate from the return of fixed income, you're virtually guaranteed to get a negative real rate of return over time. So I think there's some areas that make a lot more sense than the 40 being fixed income. So I think if you think about gold, that's done a much better job than fixed income. It also doesn't create taxes just by owning it, but it does tend to keep up with inflation without creating that tax impact. If you think about something like land or farmland, that does a very good job of keeping up with inflation without throwing off a whole bunch of taxes as well. And if you think about managed futures, like we're doing in that Milburn fund, that's been, I think, the holy grail of the combination of how to balance your risks, meaning, bonds can do well in a bear market, but they can also do poorly in a bear market like they did in 2022. By definition, if you can characterize what type of market you're in that it's a persistent bull trend or bear trend, that's actually outstanding for managed futures. So I think a combination of real assets like gold or farmland combined with managed futures for your 40 makes a lot more sense than fixed income.
And what about other alternatives like private credit, private equity? Broadly, how do you see those fitting into a portfolio?
Well, I think the thing with both private credit and private equity is there's such an incredibly broad category that it's very hard to group them and give them one categorization. So if you think about it from the perspective, if you're going into some enormous private credit fund that's tens of billions in AUM that has really crummy liquidity and high fees, that's probably going to be a pretty crummy risk-adjusted return investment. Although if you compare that to something that's much more specialized, that's doing small loans to growing businesses, that's very much doing one-off underwriting, that's getting some really significant equity-like returns with fixed income-like protection, that can be great. If you're doing the really high end of private equity, you're really paying private equity fees, the 2 and 20 fees, all the underwriting fees, all the costs associated with operating private equity, and yet you're not getting the liquidity that you get from public markets. I think you're much better off if you're talking about large cap private equity, just owning a slightly levered version of the S&P 500 and not paying the 2 and 20 and dealing with all the liquidity. But if you take a step back and say, okay, well, where are there real opportunities in private equity? If you look at the really lower end of middle market, those companies that are between, say, 1 to 5 million in EBITDA, a lot of those companies trade at like 5 to 6 times earnings. And if they're trading at 5 to 6 times earnings based on enterprise value, and you do a turn of leverage on that, it's really coming down to 3 times EBITDA. And a lot of these small companies have a lot of potential to grow quite significantly. So if you're starting from a place where you're paying 5.5, 6 times EBITDA, and you're adding some leverage to it and getting some tax efficiency, I think you can get 20% plus IRRs. So I think it's really, you need to focus on where the inefficiencies are in private credit or private equity if you want to do it, and stay away from the really, really big names in the space that have an incredible amount of it, AUM, and some pretty high fees.
And it just broadly in the overall environment, if we look further out, can you speculate on sort of where we think we might see upside surprises over the next 6 to 12 months, and also where we could be surprised to the downside?
Sure. Well, I think the places where you can see the really big upside surprises are if this AI boom tends to be not something that's fleeting. All of these memory companies, yes, are they up an enormous amount over where they were just a year ago? Or the Bitcoin miners, not that I like Bitcoin mining, but they certainly have the power supplies lined up, that if this AI boom is not something that's ephemeral, that goes away, those companies are just going to continue to boom, because nobody's pricing this like it's a secular market where those earnings are just going to continue to grow like they are for an NVIDIA. So if you think about an NVIDIA, is NVIDIA really the bottleneck? I think you could certainly argue they do have a bottleneck, and nobody has chips that are comparable to NVIDIA. But the multiples that you pay for a company like an NVIDIA or an AMD are nothing like the companies like Micron or an SK Hynix, where they might have the same power to the mode, at least for several years, where people just don't have that incremental memory capacity or power capacity for a company like a Bloom Energy. So I think that's where you might get some of the biggest surprises to the upside, even though it already has surprised in a pretty big way to the upside. And then I think the areas where you might get the biggest downside are those where they're the most sensitive to shocks in the economy. So I think like airlines could do pretty poorly. Cruise lines, this might be a not great environment for them. Areas where the consumer could get pinched from rising inflation. I think that's where you can get the negative surprises.
And David, lastly, we've covered several topics here, from process to construction to navigating market uncertainty. In summary, when you look out over the next year or so, what's the playbook? What's the investment playbook you would suggest for people to look at?
I would say that, the past couple decades have been a phenomenal time to be indexing. And I still think indexing is fine. Generally, if somebody doesn't want to put in the work, but if you're willing to put in the work and you're really willing to go out and figure out where are the bottlenecks in the market, where do people have products or services that people aren't choosing to buy, but they have to buy, and they'll pay whatever they need to. I think that's where you're going to find the best opportunities in the market over the next 3 to 5 years, rather than taking that simplistic indexing view. I think you can forget a lot of these companies that are basic industrial manufacturing. You can forget a lot of these companies that are oil and gas. You can forget regular car OEMs. You can get rid of a lot of that stuff in the indices and just focus on those companies where they really have that ability to have persistent high margins and high return on equity.
David, thank you for sharing your highly valuable insights and perspectives with us today. And to our listeners, thank you for tuning into Compound Insights from CFA Society New York. We'll be back soon with more conversations with leaders in finance. Until then, I'm Gary Farber. Thank you for listening, and we'll see you again soon. Leading a financial service firm requires a distinct approach to strategy and leadership. That's why Harvard Business School Executive Education offers a 5-day in-person program focused on leading professional service firms. In this program, participants like you will explore topics such as corporate culture, retaining talent, and communicating a strategy and vision. By the end of the program, participants will gain frameworks to lead change while preserving client satisfaction. Explore the program at hbs.me/client. That's hbs.me/client.